Welcome everybody to Know Your Numbers. Thank you very much for making the time to be here today. I'm hoping this will take no more than about 45 minutes. We will have time at the end for questions if anybody wants them. And just a little introduction to me. So I'm Tamsin Jefferson Harvey. I run Seed Accounting Solutions. We have been going for 6.5 years now, and we work mostly with small and micro businesses, a mix of sole traders, limited companies, partnerships. And we're very passionate, I suppose, about working with clients. So we're not just here to do a tax return at the end of the year. We're really selling a relationship, I suppose, with our clients. And as part of that, we do also run this educational content with complimentary webinars to help further understanding of running a business and the things that are involved in it. So if you do need to contact me, there's my email address. You can obviously email me. You can probably find me on socials as well, which might be how you found out about this webinar in the first place. Okay, so we're going to start off the session with a quote by Jack Lew. So the budget is not just a collection of numbers, but an expression of our values and aspirations. So hopefully you've all updated your budgets and forecasts to reflect the challenges of the last 18 months. But the budgets and the forecasts are really effectively expressing your values and aspirations for your business for the next 12 months or whatever period of time you're preparing your budget for. It might be the next calendar year, it might be a tax year, or whatever. So it's really important that you understand, monitor, and measure what you've set in those budgets and forecasts. There's no point in just kind of creating something and hoping that it's going to work and it's going to sort of materialize into something tangible. So this webinar is about demystifying the most common reports you'll be seeing on a weekly, monthly, quarterly, annual basis in your business, or that you might want to run a sort of interim period of time just to see how the business is going. If you don't have an accountant, it might just be helpful to be able to know, how to run the report and when you run the report, what those figures are showing you. This obviously all helps you sort of stay in control of your business performance. Now, next up, just thought I'd share the core values that we have at Seed Accounting Solutions. So our three sort of core values are educate, support, and empower. So for us, it's super important that all business owners are educated with the information that they need to become the business owners that they want to be, that they've got all of the information that they need to make the right decisions, and that we're there then to support them through that journey from when they set up the business to whatever the next stage might be, whether that is to retire from the business or sell it or, hand it over to the employees or whatever. And finally, really is empowerment. To me, it's really important that business owners are empowered. They feel confident and educated and supported enough to actually make all the decisions that they need, and that they don't feel like they're floundering or they're lost. And, running a business can be really tricky and really trying at times. And I think being empowered to make those decisions on your own without worrying about the outcomes and the consequences is a really important factor of being a small business owner. So educate, support, and empower. Those are our three core values, and our passion is to work with small businesses to help them achieve their goals via these three core values. So over the next 45 minutes, we'll be covering the importance of knowing your numbers, an overview of the different reports that you should be producing or that you might be provided, the difference between profit and cash, the key drivers of business value, how to protect your assets, and how to adopt best practice. We'll then outline some potential next steps for you to take to make sure you truly understand your numbers. And please make sure to take notes. Some of what we might talk about today might sound a little bit foreign language to you, what I like to call Accountanese. So do send through your questions at any time during the webinar, and we can answer towards the end of the session. Now what I'm going to do, I'm going to turn off my camera, so it's very distracting. And where can I do that? And we will go to the first slide. So why do you need to know your numbers? So you obviously know that you need to know your numbers, because otherwise you probably wouldn't be here. But at the end of the day, knowing your numbers is vital, because it allows you to interpret your reports and know if you're on track to achieve the goals set in your business plan or your recovery plan or whatever it is that you set yourself. Here are my top 6 reasons why you need to know your numbers. So first of all, they tell the story of your business. They allow you to interpret the results of your business activity. They help you identify the symptoms versus the root causes. For example, a decline in gross profit is a symptom of many root causes, such as ineffective pricing, rework, poor purchasing, wastage, and so on. So knowing your numbers will enable you to spot an early warning sign of a potential issue. For example, monitoring how long it takes customers to pay you allows you to quickly respond if that number starts to increase. Areas of strength and weakness will be highlighted. For example, your balance sheet indicates whether your business value is going up or going down. Understanding your numbers also means you have reliable information to base your financial decisions on. And finally, knowledge is power. The more you know about your business, the better your business will be. I just want to add in something extra to the end of all of this, which is a saying that I love to share with my clients. And actually, I share it with family and friends quite a lot as well. But I can't even remember who it is. I did look it up a couple of days ago to find out who actually said it, but nobody seems to know. It might be Peter Drucker, or it could be Robin Sharma. Anyway, what gets measured gets improved. If you're not measuring something, you can't improve it. If you don't know what your starting point is and what your desired endpoint is, and you can't track that progress, you don't know whether you've made any improvement. Things might feel easier, but you don't actually know genuinely how things are doing. So that, to me, is the ultimate reason why you need to know your numbers, because you can only improve a situation if you're measuring the figures that will help you get there. So today we're going to be looking at the key reports, each of these ones on this list, to help you understand what you can learn from them. Some of them have different names, terminologies, but this is most likely these are the most likely titles that you will see in the sort of common software used nowadays. We will be using the same fictitious company called Foods Co for the examples. So I do have some nice demo data to use for this. So your trading account. Your trading account tracks your sales, variable costs, and gross profit to calculate the return you're achieving before deducting your fixed overhead costs. So your gross profit percentage indicates whether your margins are improving or whether they're deteriorating. You can track your results across different divisions or product lines by using multiple trading accounts. For example, if you have regional locations, having a trading account for each location allows you to track how each is performing. You might also have different revenue streams, and you may wish to have different trading accounts for each of these different revenue streams. Small adjustments to the items in your trading account can have a huge impact on your overall results, which I will demonstrate now. Now, just before I go into this, I'd like to caveat this, that the trading account is usually included in the profit and loss report in most sort of common software nowadays. So your trading account is effectively your sales or your turnover and your cost of sales. So those are the sort of figures and the titles and the sort of words that you're going to be seeing on reports. So this is an example of a food manufacturing company's trading account. As you can see, they had sales of just over $1 million, costs of sales of 318,000, giving them a gross surplus from trading of just under 700,000. Their direct costs were just over 450,000. So as you can see, that's things like delivery costs, direct wages. So again, that would be any sort of labor costs that relate to the sale of their products. It could also be their delivery drivers, their packaging people, lots of people there basically in the production line. So that's all their direct costs. So their gross surplus was £248,749, giving a gross profit percentage of 24%. So let's say this company undertakes coaching with their accountant and implement strategies to increase their customer retention rate, resulting in a 10% increase in sales. They also work with their accountant to review their inventory processes and reduce their costs of sales by 5%. They then renegotiate their contract with their delivery provider, resulting in a 5% saving in their direct costs. And as a result of these changes, their gross surplus has increased by £140,251. and our gross profit percentage has increased from 24% to 35%. So as you can see, understanding your trading account allows you to identify areas where small improvements can have a big impact on the profitability of your business. Now, the reason we isolate these from your overhead expenses is that generally your direct costs and your costs of sales are variable. They will vary depending on your sales volumes. So for example, if you're a product business, if you sell more, you need to buy more stock. So they're always going to be variable costs. However, the percentage should theoretically stay relatively constant. And that's really where you need to be looking at. And it's the same in services. If there are any costs relating to the sale of your service, you need to be including them in this account here, in this trading account, in your cost of sales. Don't lump it all down in your overhead expenses. Really important to know that in order to sell £100, how much is that actually going to cost you in labour, software expenses, Stripe payment transaction fees, all those kinds of things. So those are the things that you're going to see in your trading account. So then we move on to the profit and loss statement. Now, as I mentioned, the profit and loss statement will, in most software, include the trading statement as well. But the profit and loss, also known as an income statement, shows all your earnings and costs over the year and tracks the overall performance of your business. It matches your income and expenses for the period with adjustments made for timing differences. So, for example, sales that have been made, but money hasn't yet been received. It's important to remember that profit is not the same as cash. We will be going through that later. The profit in your profit and loss statement includes non-cash expenses such as depreciation. You must ensure you have sufficient profit to cover cash costs such as loan principal repayments, asset purchases, and your own drawings from the business. Your P&L, or your profit and loss statement, I'm going to abbreviate it to P&L, provides a framework to benchmark your results by using percentages or comparisons between years to compare your business performance to similar businesses. You can also run this statement on a quarterly basis or on a monthly one to track the business's performance over a period of time. I find that really helpful to look at seasonality of the business to ensure that, you know, I quite often run the P&L in my business just to check that the coding has remained consistent in my bookkeeping, for example, or to recognize potentially when a cost is coming up. If I haven't forecast it, I can go back and see that 12 months ago I paid an annual fee and therefore it's going to be coming up soon. Businesses are generally valued using a multiplier of earnings. So your profit and loss statement is a fundamental driver of the value of your business. So if you're looking to sell your business at some point, it might not be now, it might not even be in 5 years' time, but in 20 years' time, the P&L is what's going to drive the value of that business. The higher your earnings, the higher the value. Sometimes it's done based on the profit of the business, and sometimes it's done on the turnover or the gross profit. So bear that in mind. So this is an example of a profit and loss statement using the same fictitious food manufacturing company and the same figures. So we've taken a gross surplus from the trading account at £248,749. And we've listed all of the expenses followed by the owner's remuneration to calculate the net surplus or loss. We might call it net profit. As you can see, the company is currently trading at a loss of over £113,000. So that's right down at the bottom there. So let's say the company is undertaking a review of all of their expenses with their accountant. They identify potential savings to be made with their insurance and their rent. They contact an insurance broker and their landlord and negotiate a 5% reduction of both expenses. So they've now saved £597 in insurance expenses and £2,868 in rent. However, you'll notice that accountancy fees have gone up. Remember in the previous example, the company had engaged their accountant for coaching and other services. They've spent extra money. However, despite the increase in their accountancy fees, the overall net surplus has increased by £138,000 to £24,000 due to the savings made. So a 5% decrease in rent, and a 5% decrease in insurance overall has given them a much better. Your balance sheet, also known as a statement of financial position, provides a snapshot of your business's financial position at a specific point in time. It measures the net worth of your business, which is your assets less your liabilities. It also shows if your business is solvent. If your liabilities are greater than your assets, then the business is insolvent and urgent action is needed to fix this. You can compare different periods to determine whether the business's net worth is increasing or decreasing between years, or you may want to do it in quarters as well if there's been a lot of improvement or deterioration in the business. The stronger your balance sheet, the easier it will be for your business to survive a downturn. So for me, the last year, looking at our clients' balance sheets has been a real indicator of how they're going to weather the storm. The report also provides a basis to calculate key ratios such as debtor days, inventory days, and all of those. So it's really about the resilience of the business. So as you can see, the company, we're still working with Foods Co. The company is currently insolvent. It's got more liabilities than its assets. The liabilities down there at the bottom, 853,000, and its total assets of 548,000. Please bear in mind that there are different layouts of all of these reports, so they may look slightly different, but they fundamentally have all of the same information. So there's the total current assets, total current liabilities, and the net assets. So their net assets is a negative number. The company can't pay its short-term debts from the limited cash, debtors, and stock it has on hand. So urgent action is going to be required to remedy this. It will need an injection of funds. So based on these figures here, so they're in negative equity, their net assets are minus 305,000. They're going to need at least 305,000 to get them back into solvency. This may have to be in the form of a share capital or a shareholder loan. Assuming the company can resolve these urgent solvency issues, there are other areas for improvement too. So do bear in mind, I'm sure there's a lot of businesses out there, especially after the last 18 months, whose balance sheet is probably looking a little bit similar to this. Hopefully not as such large amounts, but with a negative net asset figure. So do pay attention to the things that you can do to improve it. Over the long term, the company could implement strategies to reduce their debtor days and inventory days to increase their cash flow. So as you can see here, their debtor days at the moment is 26 days. So to calculate your debtor days, you divide your debtors figure, so that's the 72,000, by sales, which was £1,017,925, and then you multiply it by 365, which is obviously the days in a year. This tells you how long it's going to take your customers to pay. Currently, this customer's debtor days are 26. This means that on average, it takes customers 26 days to pay their bills. If they were to update their terms of trade and requested payment within 7 days and managed to reduce this by 5 days to 21 days, they'd have an additional £13,944. Now, I'm just going to throw these figures out here a little bit. So at the moment, the company's debtor days are 26. What that means is it's likely that their payment terms are around 14 days, but very few customers ever pay on time. So if you then reduce it to 7 days, well, okay, so you're going to get a lot of people who will pay within the 7 days, and then you're still going to get the other people who are still paying late. So that's going to warp the figures to 21. So that's where we've sort of managed to reduce that down a little bit. So now we're just going to look at inventory. So to calculate inventory days, divide inventories by cost of sales and then multiply it by 365. This tells you how long the business holds its inventory for before selling it. In other words, it shows how long your cash is tied up with inventory, because while you've got stuff sitting, gathering dust on shelves, you've got no money coming into the business. So this company currently holds inventory for 74 days. So you buy your products and 74 days later, you might be selling it. If they reviewed and updated their inventory processes and reduced the amount of inventory they have on hand, they might be able to improve their inventory days by 9 days. This would result in a cash flow boost of £7,860. So while this cash flow gain of nearly 22,000 doesn't fix the solvency issue, it demonstrates how much cash could be saved with some help from their accountant, because we have lots of nice little nifty ways of improving your debtor days and inventory days and a whole host of other things. So the statement of changes in equity shows what happens to the profits. They could be paid out as dividends, or they could be kept in the business as retained earnings. They would then likely be used to reinvest in the business, might be used to purchase assets or whatever. In a majority of small and micro businesses, any retained earnings are taken out as dividends, because generally we're in business to make money for ourselves, as opposed to sort of creating extra profit for shareholders and so on. In the early days, it may well be that you're reinvesting those profits back into the company to grow it. So the statement of changes in equity represents the net worth or the value of the company and is a key indicator of the company's financial health. So it shows whether a company is solvent. And remember, if the company has more liabilities than assets, it's insolvent and funds will need to be paid into the company. So here we've got a statement of changes in equity for our food company. So the company has accumulated losses for at least the last 3 years. So this means the company has no retained earnings and is currently insolvent. There's no money to pay out as dividends, and there's no money to reinvest into the company to purchase new assets. The directors have to take action now to increase the profitability of the company. If you don't take action, you're actually theoretically detrading. So it's really important to actually make sure that you do take action and you don't ignore these figures and you find a way out. And we've got a shareholder current account. So this records all funds introduced to the business by shareholders or taken out of the business as drawings. It can help you monitor your personal expenditure from a business, and for businesses with more than one shareholder, it maintains a balance of the amount each shareholder has introduced or withdrawn from a business. It shows how much the business owes to each shareholder, and if the account is overdrawn, it means that the shareholder has taken out more than they've put in and now owes the company money. In most small and micro businesses, we would see this as the director's loan account, and it's generally the main account that's used these days in small owner-managed businesses. So to put a shareholder current account back into a positive balance, the shareholder can repay the loan, or the company can increase its profit to pay a shareholder salary, or a dividend can be declared. Bear in mind that a dividend can only be declared if there are retained earnings in the business to do so. If your shareholder current account is overdrawn, it's important to get advice from an accountant as soon as possible to discuss the best options for you and your business. There are tax implications of an overdrawn current account, and things can be done to minimize that impact if action is taken swiftly enough. So here's an example of the shareholder current account. It shows that at the start of the period, the company owed its sole shareholder, Mr. Doe, over £29,000. He's introduced 2,000 into the company during the year, but has taken out over 9,000 in drawings and life insurance payments. This means at the end of the period, the company now owes Mr. Doe just under 22,000. The amount owed by the company to Mr. Doe can only be repaid if the company is solvent and has the cash available to make the repayment. Because our example company is insolvent, Mr. Doe will need to introduce more funds into the company so that it's not trading while insolvent. To ensure the company will be able to repay the funds introduced, a profit improvement strategy should be implemented so the company becomes profitable. For example, we demonstrated in the trading account and the profit and loss statement examples of how small changes to processes could result in an improvement of 138,000. It's not sustainable for the shareholders to keep introducing money into the business if it's not profitable. That's similar to, plugging a hole in a leaky bucket. It's no good just putting a sticky plaster over something. You actually need to treat the cause of what's actually happening. And now we've got the fixed asset register, which is something that's quite often hidden. Certainly in Xero, it's very hidden, but it's also known as a depreciation schedule. It's a record of the business's fixed assets. So it could be vehicles, it could be equipment, it could be computers and printers. It could be specialist equipment for your business. It could also be desks and chairs and furniture. And basically the depreciation schedule, the fixed asset register, facilitates the spread of the cost of assets over their useful life. So for example, a desk we might put down as having a useful life of say 10 years. A laptop might only be 4 years. So the fixed asset register provides a basis for keeping track of the business's assets and can be a useful guide to determine when assets need to be replaced so that they can be budgeted for accordingly. It's also useful when selling a business as it records the current value of all fixed assets. And obviously, if somebody's buying a business and the assets are all in place and they're still very valuable, then the business will be worth more. So here's an example of the fixed assets register. So it lists the name of all the fixed assets, with the second column listing the cost of the asset on the purchase date. The next column shows the opening value of the asset at the start of the financial year. This is the cost less the closing accumulated depreciation from the previous period. So I mentioned that we depreciate an asset over its estimated useful life. The next two columns show any purchases of new assets or disposals of old assets. A disposal could simply mean that the asset has reached the end of its useful life for depreciation purposes and no longer holds any accounting value. Then we have the depreciation rate and the method of depreciation used. This company uses the diminishing value or the reducing balance method, which depreciates each asset by a constant percentage each year. The next column shows the depreciation for the period, followed by the closing accumulated depreciation. So the depreciation, the penultimate column there, the depreciation is the charge that's been accumulated in that year, and the closing accumulated depreciation is the depreciation that has been accumulated over the period since it was first purchased. I think that makes sense. I hope it does. So the closing value, this very last one here, is the figure of the current value of the asset, and this is what will be recorded in the balance sheet. So that finishes off the summary of our 6 key reports that you should be producing and reviewing regularly. I would say the 2 most important are your profit and loss and your balance sheet. They're effectively a summary of all of those 6 reports as well. Nowadays, anyway, they're generally all sort of mixed up together. I mean, obviously, if you need to drill down further, the fixed asset register will give you more information than just the figures on the balance sheet, and the same with the director's loan account or the shareholder current account. You know, if you just want to have a look at the figure and monitor that, you can just look at your balance sheet. If you need to drill down further, then obviously you'll need to look at that actual full current account. Other than that, profit and loss and balance sheet, 2 key reports that you absolutely have to look at regularly and will give you a clear indication of how your business is performing. So each report tells a different story about your business and aids your decision making in a different way. If you have any questions about any of the reports, do send them through to me now, if you can, and we'll answer them shortly. In the meantime, we're going to move on to understanding the difference between profit and cash. It's common for business owners to get frustrated that their bank account doesn't seem to reflect their profits. It's absolutely essential that you understand the difference between profit and cash, and why a high profit doesn't necessarily result in more cash in your bank account. A profitable business can go out of business because it's starved of cash, and a business running at a loss can survive because it has access to funds from investors or financiers. In other words, cash flow is every business's reality. So just got a very animated slide here, so bear with me. Hopefully it all works nicely. So to demonstrate the difference between profit and cash, consider these items. We've got VAT. It affects your cash balance, but it does not affect your profit. So that's going under the cash column. Loan repayments, what do you reckon? Cash or profit? Again, they impact your cash balance, but not your profit. Interest on loans affects both profit and cash. Asset purchases, again, only affects your cash balance. Your assets will sit on your balance sheet. They don't come out as an expense in your business. They are not going to reduce your taxable profits. Asset sales, only affects your cash balance. Depreciation only affects your profit. It's a non-cash figure. It's something that we put in, and it's an accounting adjustment. It's not a cash adjustment. So as you can see, even if your business achieved a healthy profit, if it's got to then pay VAT, loan repayments, interest on loans, asset purchases, and buy new assets, it's quite likely not going to be any cash in the bank after paying all the tax and paying all those things. So that's just a very basic example of the things that can impact your profit and your cash, and can show you how even if you've got a high profit, your cash balance may be very low. The Business 101 cycle is another useful way to demonstrate the difference between profit and cash. So first of all, when a business first starts, the owners need to invest money in the business. This money can then be used to purchase the assets needed to run the business. The business may need additional funding to buy all the assets they need, so they may take a loan on to finance the purchases. These assets are then used to generate a profit. You'll obviously start trading, you'll sell your services or your products or whatever. You've got your expenses, and then you've got your profit at the bottom. You can increase your profit by growing your sales or your margins, but overhead expenses can drain your profit and result in a loss if they're not managed. The profit then gets turned into cash. However, drains on your cash include slow collection of debtors. So if you've invoiced your customers and they're not paying you on time, that's going to drain your cash out because it's sitting in their bank account and not yours. High inventory days. Okay, going back to the stock sitting on a shelf that you've paid for and not yet sold. Loan repayments, tax repayments, payments to suppliers, all of those are going to drain your cash. A business can achieve cash gains by collecting their debtors faster, so get your clients or your customers to pay you quicker, decreasing your inventory days. So that may involve just, I don't know, well, it's similar. If you go to a restaurant, for example, quite often when they've got a specials menu, it's because they're trying to flog something that they've had sitting around for ages. When I used to work in a bar, we would always have a special offer on the wine that wasn't selling so well. It's just a way of getting rid of the stock that's just sitting there, gathering dust, quite literally in some cases. Negotiating longer payment terms with your suppliers, reducing tax, all of those things will have a positive gain on your cash balance. The owners then take the cash out of the business as drawings or personal loan repayments. The remaining cash can then be reinvested into the business to purchase more assets to generate more income. The aim is to go through the cycle as quickly as possible to increase your return on investment. So after cash flow, business value is the next most important measure of business success. Part of knowing your numbers is understanding and measuring the drivers of your business value. These drivers might be your monthly recurring revenue growth, revenue per client, sales or profit. They're going to be different for every business, but we can work with you to identify the drivers of your business value if that's what you're looking for. There's also plenty of information out there on industry standards and so on. So feel free to go out and look for benchmarking information for your industry. To enhance the value of your business, you must first develop and implement a clear plan and document your organization structure and roles within your business. Establishing cloud-based real-time reporting allows you to make better decisions, and reviewing and documenting your systems and processes ensures your business is running as efficiently as possible. This is one of the main reasons that we recommend Xero for all of our limited company clients, and we are now recommending it for the majority of our sole trader clients as well, who are looking to grow their businesses. It really enables you to have an up-to-date picture of your business performance. You don't have to wait for your tax return to be filed or your company accounts to be prepared to have an idea of how your business is performing. It also enables you to have those conversations with other business decision makers or coaches or mentors or whoever it is that's working with you in your business to make those data-driven decisions. And you can only do that if you have up-to-date, real-time information. Reducing the reliance on the owners of the business also helps enhance the value, as it will be easier for new owners to take over when the business is sold. So certainly I know that in the accounting world, when we come to sell our business, the owners are often tied in for two to 5 years after the sale to ensure that they are there to help answer any questions. And should you wish to have a clean break, you will get significantly less for your business than if you were to have a nice automated business that doesn't rely on you to make the decisions in it. And finally, identifying and managing risks means that these can be mitigated before they become an issue. So just bear that in mind as well if you're coming towards the end of your business, or you're looking to sell it, or it's something that you're looking to do in the coming years. As we've seen throughout the webinar, the profitability, cash flow, and value of your business all affect you personally. If your business isn't profitable and doesn't have much cash available, you're not going to be able to pay yourself to fund your desired lifestyle. There's a few things that you can do now to protect your assets, which I'll quickly run through. So setting up your business as a limited company to limit your personal liability. Consider who should be a director of your company and which assets are held personally by directors. Ensure that you have security over any money you lend to others. Loan agreements, some sort of security policy always helps. A way to recoup that money should things go wrong. Consider alternative ownership structures for high value assets. For example, if your business owns the commercial premises you use, consider moving the ownership of the premises to a separate limited liability company. This will help keep things nice and separate, and they're not going to impact your other business if your mortgage goes wrong. Review your terms of trade and credit policies to ensure you only provide credit to customers who are likely to pay you. This could be running a credit check on your clients. And if they've got a bad credit check, it might be that until they've got a suitable level, that they have to pay in advance or they have to pay up front. Review your insurances and make sure you have sufficient protection. For example, do you have business interruption insurance? After the last 18 months, I'm thinking a lot of people probably would have wished that they'd had that in place beforehand. Indemnity insurance. Do you have enough to cover the impact on your business if any adverse effects happen? Ensure you undertake financial planning to manage your personal wealth outside of the business. Talking to a financial advisor is super important to make sure that you're on the right track, basically, to achieving what you want for your older age or your retirement or whatever it might be. And finally, plan for the future. Do you have an up-to-date will? Do you have powers of attorney and a clear plan for transferring your assets to the next generation? All of those things are really, really important when you're a business owner. This isn't an exhaustive list. They're just some of the ways that you can protect both your business assets and your personal assets. We can help give you a bit of guidance on that if you need. So finally, how does everything I've talked about today come together as best practice? Every business should use the 3 essential tools: an annual business plan, an annual forecast, ongoing reporting and accountability. The reporting ensures that the numbers you want to achieve in your plan and the forecast are being measured. And as I said earlier on, what gets measured gets improved. The accountability process is some form of coaching. Using an independent coach to hold you accountable really does work. And knowing your numbers is just the beginning, as it allows you to improve them and ultimately achieve your goals for your business. So where to from here in these challenging times? My aim is to help you take what you've learned today and implement some positive change in your business. So it's time to decide what you're going to do. Take a few minutes after the webinar to write down 3 actions or projects that will add value to your business. I do have an exit survey from this webinar, which will ask you what those 3 things are. So please do consider listing them, and I will check in with you in a couple of weeks to see how you're getting on. What problems are you experiencing in your business? Identify these problems and use them as an opportunity to create a project to fix them. Doing nothing right now should not be an option. So now you know what you should be doing as best practice in your business. Here's how we can help you. If you don't currently have a business plan, we can help you develop one. Recently, we launched a business planning workshop. So this is where we do it online in a small group. It's over a period of 3 weeks. So it's 3 sessions. The current ones are running on a Monday. The next one we're doing towards the end of January, I believe. So if you're interested in that, please do let us know. The group session is £260. That's not plus that, actually. Sorry, it should say including VAT. So it's £260 including VAT for the business planning workshop. We do also offer one-to-one business planning services, which are also really helpful when you've got multiple decision makers in your business. So if you've got sort of 2 directors in the business or 2 owners, a sort of one-to-one can be really helpful to make sure that you're all aligned on the business sort of moving forward. So For those who need to be accountable to complete your actions from your business plan or whatever, we can also offer a range of coaching services. So they start at £75 plus VAT per month. I've skipped past the forecasting. We can also create an updated cash flow forecast, but we also have access to Futurely Predict, which is a fantastic forecasting, cash flow and profit and loss and equity forecasting plug-in, I suppose, to Xero, and it uses AI and calculations to help predict it. And it's just really helpful for business owners to be able to take control of their forecasting rather than requiring an accountant to help them. We can also create our management reports each quarter. We don't tend to do them on a monthly basis. Most of our businesses are quite small, so we choose to do them on a quarterly basis. And that fee ranges from, well, it starts at £54 plus VAT per month. This management report, we've got 3 tiers of service. So we can either send you the report, we can send you the report with a pre-recorded 5-minute walkthrough video, or we can also offer the report with a half-an-hour meeting as well. But ultimately, the report will show how the business has performed in the last quarter, highlight some areas of concern. And for limited companies, we also put in a bit of a tax provision there, just so that you can see how much corporation tax you should be putting aside. And finally, we offer a complimentary 1-hour meeting for both clients and people who aren't clients. So if you are a client, we always get in touch with you 2 to 3 months before the end of your financial year to book in that hour-long session. For people who aren't clients, you can have a discovery call session with us, which is a 45-minute session. And basically, we go through all of the bits of your business. We kind of go through your goals and the actions that you're going to need to achieve those goals, and also discuss how we can potentially work together if that's what you're after. So all of these services include an assessment as to how you can improve your profitability and cash flow. So there's going to be a great return on the investment from this process, from any of these services that you get over time. For the short term, we do have different payment options available. So please don't let cost be a barrier. If you want to get in touch, we can work together to come to an arrangement on how you can manage the fees. So the information, just as a reminder, the information in this educational webinar is general in nature and is no substitute for specific tailored advice and support. So please do bear that in mind with any of the information that I've provided. But by working with you one-on-one, we'll be able to identify the most important actions to take that will make the biggest impact on your results in your business. Okay, so that's the end. So thank you so much for staying with me over the last, well, actually 50 minutes. I've overrun a little bit, but we did have some slight technical issues right at the beginning. So if there are any questions, please do fire away now. Okay, I've got one question here. What's the difference between markup and margin? So this is generally a concern in a product-based business, I suppose. So we mentioned gross profit percentage in the trading account. It's margin and markup are not the same. So the markup in money terms is the same as the margin, and that both are the difference between the cost price and the selling price. But in terms of percentages, markup and margin are not the same. So for example, if you buy stock for £75 and you sell it for £100, your markup is 33%, which is 100 divided by 75. The margin is 25%. So that's the 25%, the £25 profit divided into the sale price of £100. Okay, so that's where the difference between markup and margin are. And basically they're down to they're sort of different pricing techniques. I actually did, I've got some videos coming up on Informe, which is a website, and I did a whole video, about 20-minute video on pricing and different pricing strategies. So that's something that you would probably want to look at in a little bit more detail. Overdrawn direct loan accounts, yeah, huge issue at the moment, especially in the last year with businesses that have had a downturn in trade, but obviously expenses have continued to go out. We've noticed this a lot in sort of construction businesses, any businesses basically that were heavily impacted by COVID. Unfortunately, the directors still needed to pay their living expenses, so they still needed to take money out, and they've now found themselves with an overdrawn director's loan account. There are a number of different ways to manage it. but they very much depend on, well, a whole host of different factors, both with the business and the individual. So it really has to be dealt with on an individual basis. But yeah, it's best to talk to an accountant about that. As I mentioned, if you think that you've got a direct loan account, the best time that you can talk about it is the minute that you discover it. Do not leave it to the year end. Really important to have a conversation with somebody as soon as possible. So thank you again for making the time to attend this webinar. We appreciate your time is really valuable. Take care, everybody, and have a wonderful rest of the week.